Welcome to our channel. Today we discuss about warning of recession signals. Risk. The S&P 500 price-to-earnings ratio is at 31.52, well above the long-term threshold of 25, indicating overvaluation. The Shiller CAPE ratio is even more extreme at 41, a level historically seen near major market peaks. Manufacturing is contracting. The ISM manufacturing PMI has fallen to 47.9, below the critical 50 level that separates growth from contraction. Credit conditions are tightening. Credit spreads have widened to 2.72, above the stress threshold, signaling rising risk aversion among lenders. The yield curve has turned positive, with the 10-year minus 2-year spread at 0.64, a pattern often seen late in the economic cycle. Labor market risk is rising, with the SOM rule at 0.35. At the same time, net liquidity stands at $5.71 trillion, but the trend is clearly downward. Taken together, most indicators are flashing red. Here's the overall assessment. The recession risk score is currently 75%, indicating elevated downside risk across the economy. Based on current conditions, the market regime has shifted into a defensive phase, with rising contraction risk. As a result, the appropriate portfolio stance is caution and capital preservation. This is not an environment for aggressive risk-taking. It's a period that favors discipline, patience, and downside protection. The signals are flashing red, and history tells us what usually comes next. Something important just changed in the market, and most people aren't paying attention. As of January 29, 2026, multiple recession indicators are now flashing red at the same time. Historically, when this has happened, the economy was already closer to contraction than expansion. This isn't noise. It's a signal. Risk levels are elevated, and the margin for error is shrinking. Let's break it down. 1. Manufacturing has officially contracted. Manufacturing has officially moved into contraction. The ISM manufacturing PMI has fallen to 47.9, below the critical 50 level that separates growth from contraction. Sustained weakness here has historically been one of the earliest recession signals. 2. Valuations are at extreme levels. Market valuations are stretched. The S&P 500 price-to-earnings ratio is at 31.5, well above the danger zone. The Shiller CAPE ratio is now at 41, one of the highest levels in U.S. market history. Conditions like this have typically preceded sharp declines in future returns. 3. Credit markets are starting to crack. Credit markets are showing signs of stress. Credit spreads have widened to 2.72, moving above the stress threshold. This indicates tightening lending conditions and rising risk aversion across the financial system. 4. The yield curve is sending a late cycle warning. The yield curve has turned positive, with the 10-year minus 2-year spread at 0.64. Historically, this shift tends to occur late in the economic cycle and should not be mistaken for a green light. 5. Labor market risk is rising. Labor market risk is beginning to build. The SOM rule indicator is at 0.35, below the recession trigger, but clearly trending higher. By the time this signal turns red, economic weakness is often already underway. 6. Liquidity is draining from the system. Liquidity conditions are deteriorating. Net liquidity stands at $5.71 trillion, but the trend is downward. Markets rarely break on bad news, they break when liquidity disappears. Taken together, these signals point to elevated recession risk. This doesn't mean panic, but it does mean adjusting expectations and positioning defensively. Historically, this phase favors cash and liquidity, defensive sectors, strong balance sheets, and lower leverage. Risk-on behavior at this stage has not been rewarded in past market cycles. The focus here isn't fear, it's discipline. When you put all of this together, the picture becomes clear. Manufacturing is contracting. Valuations are historically extreme. Credit conditions are tightening. The yield curve is flashing a late cycle warning. Unemployment risk is rising, and liquidity is falling. All of this leads to one clear message. Recession risk is elevated, roughly 75%. This is not an environment for aggressive risk-taking. This is a capital preservation environment. The goal here isn't fear. It's preparation.